Welcome to the Airme Roundtable. Today's the 23rd of February, 2022. Special guest, Bruno. Bruno and I go back a long time. I think we've met probably in the early 2000s. So it's been pushing 20 years that we've known each other. And Bruno used to run the Rhino trade alert service for us, and now he's running it for a private capital. And Bruno was kind enough to come back to the roundtable and give us an update on how the Rhino's doing. So it's nice to have you back. Always a pleasure, Bruno. And yeah, it's curious how the Rhino's going for you.
Thanks, Tom. Thanks, Tom. Some of the audience may know me. I mean, and as you correctly said, we've known each other for a long time. And I used to run the mentoring service on the Rhino. And then I was hired as a quant trader for a family office. So it's like private capital or a closed fund. And so my presentation today will be my type of Rhino. And for those who may have watched earlier presentations since 2016, probably, I've always said that the Rhino may not be a generic buckle and butterfly strategy, but still a very versatile, very flexible type of strategy. And so I have customized my Rhino as a conservative Rhino, and I will try and go through what I've been doing and what is my thinking behind it. So if it works okay, my introduction, because we're working in a very high vol environment. And something that I've said in previous presentations that many traders are not fully aware of is that we are Vega traders. We trade, we manage our delta, but basically the crux of the matter of the strategy is to sell volatility and of course capture theta over time. So I always remind that we have to take care of our Vega exposure. Okay, so let's start. As a preamble, and again, for those who have known me for some time, I'm not a big fan of backtesting or automated strategies on options. I don't think they work. There are a few, I know on some occasions I'm wrong. I know there are some set and forget or no touch strategies, but most of the times it's better not to stick to rules, and that's why my conservative Rhino has evolved into a stripped down version of the original one. And the key guideline is to try and keep a flattish delta over the largest possible range, and even more so when volatility goes haywire, like at the moment. Because it's important to have a routine, I always initiate my trades in a typical Rhino style. And we will see that there's a little caveat that because I want my delta to be flat to negative, it's not exactly the same type of entry as before. We will see that my entries are generally more OTM. I know that we forfeit theta by doing so, but that's the way it is. Another thing also is that, and also a reason why I don't really believe in backtesting, because we have to analyze the volatility. We have to analyze the VIX, even sometimes short-term VIX, the VIX 9D. And so I mean, people who backtest, they want to have a simple rule to follow and to stick to, and they don't really take into account that, for example, now we are in backwardation. Or so what do you do when you're in backwardation? Are you sticking to the same strategy? I mean, head down with preset adjustments? I don't think so. So we have to adapt. And adapting also means that I know it's a bit of a dilemma for me to say that the Rhino is a simple strategy. At the same time, I also say that you have to know your Greeks. You have to know what's going on under the hood, because and so maybe it's the way I trade it is maybe not the beginner's type of Rhino. It's more intermediate to advanced. But anyway, I will go through my line of thinking, and hopefully it will be easy to understand. So my current trading environment is okay because now I'm a professional trader. I have a professional routine, and my routine involves, for example, and I'm going to show you TradingView, analyzing the market and the markets. So I check SPX, of course, and because of the high correlation, I also check what's going on the NASDAQ. There's a very strong correlation at the moment between NDX, SPX, and even the Dow Jones. So I check which one is leading the market. But I mean, really, for those who are trying to diversify, which is not my problem really, but it is something that we have to look at. And I take it as a positive that if you follow the tech titans, the FANGs, I don't know whether I can see them here. The Zoom is taking a bit of my space anyway. So I check the FANGs, I check also the GJY. I also check how VIX is behaving. At the moment is picking up quite nicely, but there's a good resistance here. So I don't think we will have a major sell-off today. So I check FANGs, I mean, because of the tech titans really lead the market wherever. And because now the market is a little bit shaky, I also look at what investors are doing in terms of divesting from techs and moving towards value. So I check the VUG over VTV. And as you can see, we have a move towards value stocks, defensive stocks. So all I'm saying is that as a professional routine, you have to look beyond your SPX and you have to really analyze what's going on. I also check the interest rate situation, the credit market, the 2-year, 10-year treasury spread, which is at the moment is not looking great. Of course, we have GDP tomorrow, so I also look at economic indicators. But okay, I mean, this is not a presentation about market reading, but this is an important thing. Another essential part right now is that we work in a very high vol environment, and so it has affected the way I trade the Rhino. I will show you the current positions, and of course, I mean, to me it's common sense, but I mean, if there are questions, I can understand. But for example, I will blend my broken butterflies with balanced flies to have a little bit more negative delta, things like that. Another thing is that I use what I call professional benchmarks. I use a target in terms of margin to equity. I use a target in terms of value at risk. It may look a little bit of an overkill for a individual trader, but there are good. It's a good routine. I mean, it's a good way to prevent catastrophes. If you manage your margin, if you manage your max loss for the day, this is something that I believe is important. So in this presentation, I will show you my conservative Rhino. But as a quick aside, because I understand that some people will say, "Oh, whoa, you're going too far away from the Rhino." So for those who have seen previous presentations, the question I would have expected, and I would expect at the end of this presentation, is that would a standard Rhino with the standard guidelines, standard rules work okay? Yes and no. I mean, the market has been bullish high vol for quite a while, and high vol means that you pay less for your broken butterflies, and being bullish means that you just have to handle the upside. And overall, if you don't mind starting your position with a positive delta, like for example, a few years ago, the RTT was prepared to, unlike the RTT, the Rhino is supposed to start with a flattish to negative delta. The RTT was not too bothered about that. So if you have an RTT mind, so to say, maybe you can start. But this is not my trading style, and it's not conservative enough anyway. So, as we are seeing now in the last month or so, or at least the last few weeks, an RTT can be quite treacherous when the market starts correcting deeply, and that's where I think being more conservative, maybe I would make less money by always being delta flat or delta negative when the market grinds up. but I think it is safer. So this is a very safe approach. But for those who are more bullish than I am, or people who can stand more drawdowns when market dips pretty deep, yeah, why not? It's really like a buy the dip approach. I mean, vol pop, enter, another vol pop, increase into your position. That's okay. I mean, it's just not my style. And as I said at the very beginning, the Rhino is very versatile, very flexible. And for those who are in that type of mind, there's no problem at all. In terms of what I also look at, as I said before, I look at VIX 90, the short-term volatility. I could also look at VVIX, volatility. And also in the last few weeks, we had a different regime where, I mean, seasoned traders know that generally we sell more volatility than realized volatility over time. But lately we had strong realized volatility that was not really compensated for adequately, I would say, with IV. So IV was, even though VIX was high, VIX was probably not high enough. The level of hedging was probably not high enough for the risk in the fluctuations of the market. So that's something I always look at. I mean, are we being paid properly for what we do? So I had already my quick aside on market reading. Here we see calculations I also make every day. These are the correct calculations from yesterday. SPX VIX correlation is very strong, 93%, maybe 92 today. I mean, it's still pretty strong, and that is good. When SPX VIX, the correlation goes positive, something is brewing in the background, and you can check on the chart the SPX VIX correlation versus SPX, and you will see that generally something is going to happen, a correction or not. On this particular sell-off or correction, we didn't have a change in the correlation, but that happened. So it doesn't mean that you have to wait for correlation to deteriorate to get that signal. But when you have it, be careful. As I said, also, we have a very strong SPX NDX correlation. And if you do an SPX FANG, I mean, Facebook, Apple, Amazon, Netflix, Google, and I also add a Tesla and Microsoft to the mix, it's pretty strong. And we also have a very strong SPX Dow Jones correlation. And when you look at the performance day to day, I mean, the daily moves, generally, SPX is halfway between what's going on in Dow Jones and the NASDAQ. So in a way, it's pretty easy at the moment. You just have to check what's going on with the tech titans, the big five of the market, and you should be able to, if you have any competency skills in reading the market for those big ones, you should know where the market is going. So again, that's something that's I really recommend, advise to do, is to check those correlations and check what is moving the market. We will see that there's something else to look at in a moment. So adapting to high volatility. This is just a reminder of something I said in a previous presentation for that East Coast group, the Raleigh Durham or something, is that in high volatility, it's not a fail-safe thing, but it makes sense to increase wing sizes. By increasing wing sizes, you have a PCS, or it's not PDEs, PDS ratio that decreases a little. In other words, you have a stronger, firmer PDS, and so the larger wing sizes will make your resilience on the downside a lot better. I still use a 25 difference between PCS and PDS, and the reason is that it makes my margin calculation both on Reg T or portfolio margin easier, because it is the same. It uses the same capital, whether it's a 100/75 or a 125/100. It's exactly the same. Conversely, and something that I wish I had done at the time when vol was rock bottom in 2017, is that one should actually decrease wing sizes. I mean, this is something I've learned over time. And if we ever go back to a low vol environment, I will also, I've learned my lesson. Because my prevailing principle, my ruling principle is really to keep the delta flat to slightly negative. You have to move your broken butterflies further OTM, because as high volatility pressurizes the T plus zero, it's easy to see that you would start with positive delta, which I don't like. So I move my broken butterflies OTM and sometimes 100 to 200 points below to get what I want. You'll pay a cheaper price as well, because the price of a broken butterfly is not only the volatility, is also you pay for being closer to the tent. So it's cheaper, and the downside, because there's always a flip side to anything with options, is that you will have a lower theta, but that's okay. And at the moment, when volatility is really high, like above 28, 30, unless I would really increase my wing sizes to something huge, or move my broken butterflies very far OTM to the extent that there will be very little theta, I do now more and more often, I combine my broken butterflies with balanced flies. And that's, to me, the best way to have a good balance in between theta and negative delta. As I said, all those things are pretty moderate variations. It's just a simple way by mixing larger wing size broken butterflies and balanced butterflies. It's just a way to balance risk. And overall, it's fine. Some people would start with calendars, or that's more complicated. I still believe what I do is simple. So we're going to look at a typical cycle. In this case, in the next slides, I will show you I think it was a February cycle. Again, bullish high vol, entry still around 770 DTE, ATM versus OTM versus ATM, as I mentioned. And also, you can choose your level according to support resistance levels. So good support at the moment is around 4150. So maybe when I enter May pretty soon, I will check whether my shorts are below 4150. Which is now, I think we are below 4300. So maybe 150 to 200 points under the money. That's something I will look at. Pricing. I don't really look at optimal entry prices. But we know that pricing is two-dimensional. The best market environment is market at vol up, which is a rare. It occurs maybe 15-20% of the time, or even less. So I'm not really trying. I no longer try and get the best price. When I enter, price is good enough, I just go for it. But it is true that you either buy on a vol pop. Vol pop is less important when you go OTM. It's more important when you stick to ATM or near ATM entries. We can go into details about this, or I'd be happy to answer questions, but this is not really important. But we just have to keep in mind that yes, we sell volatility, so we have to check the volatility behavior and price behavior, two-dimensional. So what I've learned over the last few years is that, and I know that this can confuse beginners, is that I've learned to relax or even ignore delta rules. So that's something that really I had to give up on from the original Rhino. And even when the market behaves, I would say normally, not like now with the market going crazy, is that because you start OTM and the original Rhino, you had a scale in alert when the market goes up by 1%. 1%, it's nothing these days. I mean, and because you start OTM, the market is already above that limit. So I don't use regular scaling rules and I don't use delta rules. Also for that reason is that when the market runs away, the market will just shoot up or grind up, and you will never build a sufficient negative delta to scale in or adjust. So it's more common sense to start adjusting. And over time, I mean, I've been working for this firm for now 2 years. I've actually learned to use margin management and also capital reallocation. So how I move capital from one cycle to the next. These are my major rules. Okay, let's go back to something simple. A typical entry in a high roll. That was, can't read, it's too small. And I think it was a February entry in December. I used a larger wing size, as I just said. And my rule, but that's absolutely a thumbsuck type of rule, is that when the VIX is above the third quartile, which is probably 1975 to 20 these days, I use larger wing sizes. When volatility eventually goes back to normal, which is below that 1975, 20 or whatever, I will return to normal sizes. And if one day volatility goes back to low vol, so in the first quartile, I will probably start switching to lower wing sizes. So by doing this, I managed to get a slightly negative delta. In this instance, because as I said, I always check where the market is going. This is where I entered, so there was a good vol pop. And so, yeah, this is a February cycle. Well, SPX VIX was very well anti-correlated. So this is a good environment to start a trade. It was 770 G, so I mean, really no sweat. I mean, this one was very routine. 2 weeks later, I think the market was starting to grind up. Volatility went down again. Market up, vol down. When the correlation is good, that's quite normal. So the market was just picking up a little bit of profit. I always check the sweet spot, because when you start OTM, I mean, you don't want to get into negative theta and well, so the sweet spot is often a key level to do something about your trade. I'll check whether theta remains positive. I'd like to have at least 10 theta on my entry, depending on the number of butterflies I enter, because as I said before, when I allocate capital from one cycle to the next, sometimes I don't have enough capital to enter the regular entry size, which is 3 broken butterflies. Sometimes I enter 2 because I am a little bit short of capital, or because I feel that I need to have skin in the game, but I'm not too comfortable with going with the rule. So sometimes I enter 1, sometimes I enter 2, sometimes, as I said, sometimes I enter broken butterfly plus balanced fly, but I'd like to have at least 10 theta. And besides my margin management or capital management, on this type of entry, or I would say the takeoff phase in the first 2 to 3 weeks, I check whether my theta is still okay. So end of the sweet spot, theta, okay. Now, in this case, the market was grinding up, still bullish, high vol. And this is a new type of adjustment. And I've seen this type, well, it's not a new type of adjustment. It's a common sense, not rule-based adjustment, just to extend the tent on the upside. I will add something which I call, I mean, it's not something that I didn't come up with that name. I mean, a colleague of mine called it a speed bump call calendar. And so the good thing also is that you have a more balanced Vega, and because volatility holds up all the way, you're not too concerned. I mean, your call calendar, if the market keeps grinding up, it will be doing okay. So in this case, I flatten my delta, although it's not so much important. It's more really like lifting the t plus 0, t plus n. Generally, I look at t plus 7, sometimes t plus 14. The way I place my call calendars is roughly around 30 delta. It doesn't have to be a strict rule there again. If you have a strong resistance from one of the charts I showed you with my Merrimath lines, I'm going to go back quickly to trading view. At the same time, we'll see where the market is going. Probably not going well. 42.80, yeah. So if for example here, I would say that 45.25 is a strong resistance. I doubt it will be 30 delta, but that's something I will always keep at the back of my mind when placing my call calendar. Okay, let's go back to the presentation. You must accept that if the market then retraces, your call calendar will lose value, you may lose money. It's still a hedge. So it's okay to lose a bit of money on your hedge. I mean, you buy peace of mind with a hedge. Sorry, that speed bump is a bullish market type of peace of mind because you increase your overall theta and you have a flatter t plus 0 over a large range. So this is something that makes sense. And as you can see, if we look now on 14 DTE, the trade has reached what is to me a very adequate profit target of 2%. I think it's about $900. It could be a little bit more. So on $38,000 planned capital, it's probably 2 and 2.3, 2.4. That's fine. And as you can see in this particular example, it was very simple. Not much to do, just add that speed bump, wait a little longer, and then exit. So this is a textbook type of strategy management. It does not, of course, always work that way. But let's say that we keep high vol and we return to a bullish mode, that will probably work again. So the first takeaway is that conservative Rhino works pretty well. As you have seen, we start OTM, we just add that upside speed bump, and that's fine. I came up with, again, it's being inspired by great traders. I was a little bit hesitant about starting my call calendars on when I didn't need to flatten my delta, but I got convinced, and now I'm using them a bit more often. Doesn't mean that I use them very efficiently, but this type of strategy management works okay. The alternative, which I've used more often, is using CCS along with a broken butterfly, or sometimes PCS rolls. PCS rolls are, of course, more or less capital neutral and almost like Vega neutral. So it depends in what phase of the trade I am and whether I still want to add capital or not. If I'm at cruising altitude, I would probably go for PCS roll rather than adding broken butterflies, or if the market is a little bit like edgy, I will be more hesitant to add capital to my trade. Okay, so the speed bump type of upside adjustment generally works well. Doesn't mean it will work all the time, but it works pretty well. So in this case, as I've said, it's a no delta alert type of management. I know it can be confusing, but it's fine. I generally use a narrow call calendar, using on the short leg, the regular monthly expiration, and on the long leg, the month end. That's fine. If you want more of a Vega kick, particularly on the downside, it's better to go wider. 1 month wide is probably preferable. On the upside, it's not really important. There are variations on call calendars. I mean, not the Rhino as such, but similar strategy where you even start a call calendar right at the beginning. I'm not big on back testing, so that's not something I've done I'd rather wait a little bit whether the market goes up or any reason to enter a call calendar. But I understand, I mean, the people I know who enter a call calendar right at the beginning, they do pretty well. So it can work as well. A little warning is that in high vol, and that's why I was mentioning that it should be 30 delta or close to a strong resistance. In high vol, it's not advisable to let the market pass your calendar strike. Roll or add another one above, but in low vol, your calendars will be more forgiving. You can let them glide through, let the market glide through. It's not really an urgency to close it or roll it or add another one. You have to be more careful in high vol because your short leg will start weighing on the performance of your calendars, but on both directions, actually, on both ways. Something I do, but I know a lot of people don't, is that if you enter your calendars when you're in backwardation or you have a 0 to positive or horizontal skew, is going to be beneficial. Basically, if you sell higher vol and you buy vol on the long leg, that's generally pretty good. And something that can help the calendar fans is that I've done a gauge study on volatility, and in the last few years, I've noticed, and I'm not the only one, that there's less clustering as before. Gauge is that auto-regressive thing, and which, in other words, tends to indicate that high volatility calls for high volatility. So there's a cluster in high vol. And when the volatility drops, the volatility stays low for a while. This does not occur anymore. It could be a consequence of quantitative easing, too much liquidity in the market. It's hard to say, but when volatility pops hard, generally after a few days, it goes down just the same way. So if you sell a calendar when the market is in backwardation, there's a likelihood that the high likelihood that the volatility will not be sustained at a high level, so your calendar will behave pretty well. So it's selling on a high horizontal skew, high positive or horizontal skew is pretty good. So when to adjust, as I said before, more and more I use my capital management, and I use my margin, basically my margin management, to determine when I need to, for example, reallocate capital. It's very obvious when you're on a PM account, but even if you're on a Reg T account, you can use the minus 12% rule, which is more or less how PM is calculated. So calculate your risk on minus 12%, and you know what is exactly at risk right now. I am trading for a conservative fund or family office, and I use a maximum, my target on margin to equity is about 35%. And of course, there can be fluctuations, so I allow myself up to 45%. If you are more a balanced individual trader, you can go a little higher. And I remember when I used to trade on my own account, I sometimes allowed myself to be more aggressive, 65 to 70% of capital being at play at any time. But these days, I'm a lot more conservative. Also because this QE, this high vol bullish to me doesn't, high vol is good. We sell volatility, we trade almost at a bargain, but we know that there's a price to pay for that. Another thing also is that reallocating capital allows me, when the market gets after 28 DT, 21 DT, I control my gamma. Controlling my gamma allows, of course, it's theta and gamma are related. So by controlling my gamma, I do forfeit some theta, but that's fine. It's a price to pay. So I'm not greedy. I don't go for maximum theta in the last 2 weeks to try and reach my profit target? Absolutely, because I get good theta. Sometimes it works, sometimes it doesn't. So I always control my position gamma. I will show you my positions at the moment. I hope you're still holding okay in this bear market. Another thing, because as I said, in market reading, we have to look for information on various sources. And something that came to my mind, thanks to a colleague of mine and other people who inspired me, I've started looking at what dealers do. And SPX is a dealer's market. When you buy, it's a market maker that sells you something. When you sell, same way. It's not like when you trade stock or futures, or where basically the broker just connects you with a counterparty and that's it. SPX is a dealer's market. And because, of course, that's probably something you've seen in other presentations, market makers also need to balance their books. So, for example, when there's a high demand for hedging, people buy a lot of puts, so they sell them puts. But by selling puts, they also have their own risk. If the market goes down, this selling puts can be quite risky. So when the market goes, when demand for puts is high, like right now, and they sell puts to the buy side, retail traders or institutions, they have to sell futures to balance their books. And that's something that I calculate. It's called the GEX or GEX, or gamma exposure. And I'm using, or my own program is now a little bit more sophisticated, but there's a good one on a good starting point. It's a Python script available on this website. And basically what does it say is that we have, I think it was earlier today, I'm not sure it's still valid. We can update it several times a day if you want. Basically, zero gamma is where the dealers are quite happy doing nothing. At the moment, we are in negative gamma, so because the market is going down, they short. So in negative gamma, they short the market to cover the downside risk. But and you can see from the gamma exposure to what point they're looking at protection. So at the moment, I would say dealers are protecting a lot down to about 41.50. We're not looking at the gamma flip and going long, but that's the same way. I mean, when the market goes up, they start buying futures, and they're also, so these two lines, we call them sometimes gamma walls, put gamma walls, call gamma walls, and these things I look now religiously every day. There's also a similar script because, of course, the dealers need to cover the volatility exposure as well. So there's something called VEX or banner exposure. But this would be a little bit of a digression, but that's also something dealers do. They do control their banner. So specificities of my pro trading. I do trade using leverage, a little bit of leverage, 1.5 to 1.6. I could allow a higher planned capital. I could really load up my positions. I have chosen to control my risk with standard Reg T guidelines. And on my PM account, according to my margin to equity, I allow myself to leverage, gear up a little bit. So for example, I know that by managing my PM margin correctly, I can trade 1.5 to 1.6 times tranches. So even if I only use 35% of my capital at the moment, I can still have 50% more or 60% more tranches in the market. Something also I've learned to deal with is that slippage, bad fills, excuse me, especially when you start entering large size orders. That happens every day to me. I realize also that the mark price is probably more important than the mid. The mark price for many brokers, and particularly IB, is a theoretical price, and that's what market makers follow. So the mid can be something, if you don't get to your mark the market makers won't give it to you. So a lot of people follow the mid and start giving in. I mean, I follow the mark price really. That's what the market makers look at. Something also, because you may have the best market reading technique and know your ways around. Sometimes, it's something I've done recently actually, is that when you don't know where the market is going, I just hedge my Vega. So I'm not only delta neutral, but I will buy, for example, a put calendar just to mitigate my Vega risk. So I still capture theta, and of course, if, as I just said, volatility pops up hard and then decreases, I mean, yes, I mean, you will also lose on the positive side when volatility deflates rapidly. But sometimes it's just more comfortable, better for the heart to just hedge your Vega. So sometimes, and as I said, I'm not using strict delta rules. Sometimes I will just do what it takes to have delta flat and almost Vega flat. Okay, as I said before, I monitor my MTE constantly. So now I'm going to jump to the conclusion. There are many possible variations. I mean, I agree with that. On my Slack group, there are people who follow what I do. Others are more creative and they do their own thing. They have their own risk profile, and that's cool. Absolutely cool. And this is the mandate I have. I've showed you now what I do because that's my mandate. I mean, and as an individual trader, sometimes you don't have that discipline, and either you create it for yourself or it comes from your boss. But it's actually good to have one. So my margin to equity, my value at risk, all those things are very important to me. And and also by reallocating capital, every time you do an adjustment, by, for example, peeling off, like now I'm peeling off March, I'm building April, and I'm setting some capital aside for May that will be entered soon. This also is, every time you move capital from one cycle to the next, it's your opportunity to control your delta and Vega. But it's smoother. I mean, to me, it's easier to manage that way. So I would recommend not to use strict delta alerts because they don't work. I mean, last year or the year before, when the market was just plain bullish, the market can run away, and you add to your trade. And to what extent are you going to keep up with a rising market? I mean, sometimes it doesn't make sense. If you look at the original guidelines, when the market was more tame, there was only one scale in. So I think you have to deal with what we have at the moment. The good thing is that in a high vol, when the market goes up, you don't have a vol crush. Excuse me. So adding to your trade is not that complicated. Something I've not mentioned on the slides, but that was in a previous presentation, is that when I start with larger wing sizes. Okay, high vol, I start with 125/100 OTM, and I could even go larger than that. As time goes by, I will generally go back to normal size or even go narrow size. For example, if I build a trade up after 49 DT, most likely I will use a regular size 100/75 wing size. And in a very rare case where I still want to add, because maybe the market has run away, I still want to add a last broken butterfly, let's say around 35 or 30 DT. Not something I advise to do, because generally this is almost time to start scaling, start moving capital to the next cycle. So, but if you ever want to add another broken butterfly late in the life of the trade, I will go probably 75/50 after 25 DT. There again, no strict rule. It's going to be your overall T+0 delta Vega that will dictate the wing size. I mean, it's as I said, it's just common sense. So we are 3/4 of an hour, and even for my own curiosity, I would like to see where the market is. and whether my trades are doing okay. 40 to 84, so that's okay. So where are my trades? Okay, so this is March. Okay, I'm positive. A little bit too much of negative positive delta, but that's still manageable. So this is it can look like it's a very confusing position, but it's fairly easy to manage, really. Like now, I'm going to start peeling off. If the market goes down, I'm going to probably close one of the higher broken butterflies. That will allow me to flatten my delta. It will reduce my capital usage. Generally, towards the end of the cycle, after 21 or close to 14 DT, I want to be using less than 10K so that it does not impede capital allocation into new cycles. So this trade is doing okay. I've got good theta, so I'm not complaining. And again, if anything, no strict rule here, but if I want to hedge my delta a little bit more, I can, of course, close this part, which is absolutely useless now, and I can close one broken butterfly here, and that's going to be just fine. Now, and of course, this one went through a hell of a roller coaster, and I'm happier with my April trade. I think it should be doing okay. Yeah, it's doing okay. Now I have a little bit of positive delta, but that's fine. So on this one, I just went I entered probably two broken butterflies, then a third one. And little something I wanted for my own peace of mind is that when the market started going down rapidly, I added a put calendar down below, I think around 3,900. So if I was to close my put calendar here, I would have a lot more Vega exposure. The trade generally has good resilience for the first 2 weeks, 3 weeks. So there's no need to really hedge your Vega that early. But now we're going on to 77, so almost a month has gone by, and I'm starting to mitigate my Vega risk on the downside. Also because, I mean, to me, it's common sense. This market is getting a little bit risky. So I will hedge my delta and probably hedge my Vega accordingly. So, I mean, overall, I mean, this trade is doing fine. I'm above my 2% target. So I could also just take the money and go on holiday. So that's what it is. You know, just be flexible. Flat delta of a large range. This is good enough for me. I've got a range on my T+0 is from 4,100 to almost 4,500. So I can't complain. This is a large range. It's capturing good theta. Nothing I can complain about. Okay, we have probably another 10 minutes left, so I'd be happy to answer questions.
Okay, Bruno. I did have one. You mentioned your Slack group. Do you have a URL for people to join that?
Okay. It requires an invite. If I still have my bruno@aeromere.com email address, it would be better to send me, because I need to send invites individually. My Slack group is not public. You need an invite, so I will send an invite to whoever's interested. It's free. I mean, I'm not making money on that. Although I'm thinking of creating a Patreon account, because it's still pretty much time consuming. So I wouldn't mind getting $10 or $15 per month for each participant. But I mean, at the moment, there's nothing. So it's free. So again, if my email address is still valid, send me an email address, send me a mail, and I will send an invite.
Yeah, I'll make sure that alias works.
Otherwise, I can give you in the chat group. Chat. Okay, I've got a generic bv@sfr.net. That should work. That should also work. Oh, it's all panelists. Oh no, I want to send to everyone.
Oh, so that email address, that SFR.fr.
Well, it's short and sweet. I mean, I've got longer email addresses, but I like this one.
That's a
Can't
good
get any
one.
shorter than that.
Yeah, that's just pretty good.
Okay, so that's one question. I know I may have lost quite a few people. I'm sorry about that. You know, there's a lot to talk about in just an hour. But I can recommend everyone who has not seen the previous presentations in the last 2 years. The principles haven't changed really. So there's been some adaptation to the market, but still same stuff. So, and maybe you need experience, some skills, and of course to know your stuff. I am a big fan on learning the Greeks. I've mentioned Vanna today. I know for many traders, Vanna doesn't mean a thing. So yeah, it's important to know Greeks. But I can answer questions on the Slack group with pleasure.
Okay, I just added that to the a link to your email so people can request that.
I sent you a link to the presentation. It's a PDF.
Yep, I've got that linked as well.
Okay. So have I lost everyone, or are there still a few more questions?
I don't see any more questions. Everybody's pretty much still here, so I guess they absorbed what you were saying.
Okay. I'm sorry. I know, coming from a quant background, I know. I mean, some people believe I overcomplicate things. No, I don't. I mean, it's still a very simple thing. It's common sense and experience, and I'm very happy to share experience with. I mean, but I only do it on my Slack group at the moment. I really have very little free time. I mentioned that I've done a Gotch study, and I'm working on an automated volatility strategy. I do a lot of things. And I'm coding something I showed before, Gex and Vex, to try and figure out what dealers are doing on the other side of the market. Yeah, so that's for any question, contact me on Slack and I will explain. I can share some code as well. So, okay.
Kieran asked, when exactly do you hedge for Vega by adding a calendar? And what are you looking at, the Delta Vega number, the underlying?
The thing is, I can't really hear you. I hear myself.
You can't hear me? Oh, can you see the chat?
The sound is very muted.
Oh, can you hear the chat or read the chat?
I can read the chat here. Okay. Is the question on chat?
Yes.
What are you looking at? Delta, Vega number, underline. To hedge for Vega, yeah, I use a calendar. When I feel the market is about to collapse or something, and I feel I've got too much Vega exposure, or let's say I just want a holiday, I don't want to look at the screen for 24 hours or 48 hours, then I will hedge my Delta and my Vega. I generally use calendars. In high vol, calendars do well. Backwardation, also a good time for calendars. But you can also hedge your Vega by buying a PDS, but some people feel that having more directional adjustments can backfire on you. I can understand that. So I would say my Vega hedging is mostly with calendars on both sides. What are you looking at? Delta, Vega, underlying? No, my T plus 0 is my key thing. You know, I want my T plus 0 to be good looking. For example, today I checked volatility over a month, and I knew that we have a 1SD is 70 points today. So we hit, I think, 43.50 earlier. Now we were down to 42.80. This is normal market behavior. So it's only one sigma, one SD, and nothing major. So it can be, of course, traumatic for some people, but so what I want really is to cover my one SD on both ways. And sometimes if I feel that my Vega is going a little bit too risky, I will hedge. I mean, if you place I place I mean, as I just said, for example, for April, my calendar is on 3,900, so it's not a big kick to my position. I'm still very negative, but I am definitely less very negative than I would be if I didn't have it. So it's mitigating, and sometimes, as I said, sometimes if I want really to disconnect, switch off, I will hedge my Vega completely. That has happened, but a hedge is often a cost. If you really want to hedge fully, I mean, a hedge is always dynamic. A hedge, I mean, you can't control everything on I mean, for any underlying and all the time. It's very much dynamic. But I'm trying to hedge at least to be comfortable, at least for sometimes 24 hours. For example, if I'm not, okay, tomorrow we've got GDP and the market will move again. But to me, that's not as important as, for example, the tension in Ukraine. If I feel that something big can happen, yes, I will hedge. And sometimes if volatility then deflates completely, it's going to be a waste of a hedge. Yeah. So do you take off a hedge? Yeah, I mean, yeah, of course. Yeah, it's there's a hedge that I keep peace of mind of a week, 2 weeks. For example, I put on my 3,900 put calendar. I may actually add another one soon. I don't know. Not that, I mean, this trade is looking good. It's already a profit target. So yeah, I may have another hedge just for the sake of protecting my profit. That's quite possible. So there are different motivations for a hedge. But generally, if it's just to protect for an event and it's the risk is gone, yeah, then I'll take off my hedge. Yeah.
So you mentioned
flexible. Yeah, sorry.
Oh, you said you mentioned you're at their profit target. When do you close down a trade?
Well, to be honest, this roller coaster of a market, I'm down 1% year to date. So I'd like to get another 1 or 2% on this trade. So, but generally, if I get to about $1,000, I'm happy. $800, I'm happy. Let's not forget that I am leveraged. So this 2% Reg T, 900 is about 2.5%. On my account, it's probably close to 4%. So yeah, I could take it off, but I think there's more
money to be made.
A little bit more.
All right, Bruno. I think that's it for the questions. Thank you very much for coming on. We're right at an hour, so good time to stop.
Yeah.
Hope things are going well for you. And yeah, again, thanks. And
Thank you, Tim.
and I've got the links in the recording for the Slack group, so I'm sure you'll get some requests for that. So cool. Thanks very much. Really appreciate it. And yeah,
thank you.
Maybe we'll have you on again in the future.
Sometimes lose people, but come to the Slack group, and I'll be happy to answer questions.
Great. We'll be in touch, Bruno, and yeah, we'll get together one of these days.
Yes, I hope so too. I mean, I know that you went to Belgium a little earlier than planned, but we'll come to Barcelona. I mean, as simple as that.
Yeah, and you're always welcome in Colorado Springs. So
I will definitely.
All right. Well, thanks everyone for sticking with us, and Bruno, we'll see you later.
Thank you. Bye-bye.
Bye.